Coming up in a moment, we have another episode of Banker on Call, produced in partnership with Shield Compliance. Banker on Call is a series where we dive deep into the financial, regulatory, and tax complexities facing cannabis businesses in today's evolving landscape. Today, we have Shield Compliance CEO Tony Repanich in conversation with one of our go-to experts on cannabis industry taxation, Jill Scher, a managing director at CBIZ. For those of you who caught our last conversation with Jill, you know she brings an incredible depth of knowledge to the cannabis space, from navigating the complexities of 280E to helping licensed operators find smart, compliant strategies to manage their tax liability. And a lot has changed, frankly, since we last spoke. The announcement from the acting attorney general regarding rescheduling, at least for medical cannabis, has sent ripples across the industry. Operators, of course, are rethinking their strategies. Advisors are reassessing their guidance. And the question everyone is asking, what does this actually mean for my tax obligations? Today, Jill's back to help cut through the noise. Tony and Jill will talk through what rescheduling really means for licensed operators under 280E, how businesses should be thinking about their tax strategy right now, and what else is on the horizon for the cannabis industry. Whether you are a cannabis business owner or a cannabis banker, or working with plant-touching businesses, or really just trying to stay ahead of the curve, this is a conversation you'll want to stick around for. So let's get into it.
Jay, thank you so much, and good to be with all of you again. And Jill Scher, so good to have you with us today to talk more taxes. So welcome back. Maybe just a quick intro you can give us on yourself and CBIZ, just for those that don't remember you from our last conversation.
Sure, and thank you, Tony, and thank you for having me here. I'm a managing director at CBIZ. CBIZ is a national accounting, advisory, tax firm primarily. We also do other things like benefits and insurance and payroll and other services. We have 11,000 people throughout the United States. My role is primarily business development and technical tax work, and I focus a lot on the cannabis space because I find it very interesting, and it's a wonderful industry, and I'm trying to help facilitate as much as I can companies as they navigate through the complexities of it. So that is my brief introduction, and I guess we're here today to talk about recent developments in the industry, and I'm very happy to do so.
Yeah. Well, last time we talked, it was around tax time, and we were talking about some of the tax strategies that licensed operators employ to reduce their tax liability, especially under 280E. And since then, now we did have the announcement from acting attorney general that we are having rescheduling, at least of medical. And so that's sort of throwing everything up in the air and having people re-strategize how to best manage their tax liability. For those that maybe haven't been following along quite as closely, just remind everybody for medical cannabis licensed operators, what's happening with their 280E obligation now that rescheduling has occurred?
So as you know, in April, just about a month ago, medical cannabis was rescheduled from Schedule 1 to Schedule 3. It left recreational cannabis where it is and in need of further evaluation, which will occur in the next couple of months. As it stands now, just as a reminder to everybody what Section 280E is. Section 280E is a provision of the Internal Revenue Code that basically says that any items that are Schedule 1 or Schedule 2 are subject to this Section 280E, which says that normal deductions are not allowable for tax purposes. So that means that the only thing that's deductible for these companies are cost of goods sold. So prior to the reclassification from Schedule 1 to Schedule 3 for both medical and recreational cannabis, the effective tax rate of these companies wound up being extremely high, sometimes up to 70 or 80%, because you were disallowed many of the federal deductions. With this change, which actually is effective as of January 1st, 2026. That's the only retroactivity. It's a little bit of a couple of months. Now, for medical cannabis operators, they can deduct all of their expenses, not just cost of goods sold, similar to any other industry. It affects companies that are primarily and solely in medical cannabis. It also affects companies that, and there are many, that participate in both medical and recreational cannabis. So for those companies that are hybrid, participating in both medical and recreational, there is going to be some guidance released from the IRS in the coming months to discuss how to determine what those costs are that are applicable to medical versus recreational cannabis. Either way, for any company that participates in medical cannabis, either solely or in a hybrid fashion, this is a great thing for those companies because their effective tax rate went from what was 70 to 80% potentially to now much lower, compatible with another company. And just to, I think you summarized it really great, Tony, in our last session. Before, the strategies were for these companies to only deduct cost of goods sold. There were a couple of strategies that these companies did to help them to mitigate this burdensome tax. And primarily, there were really three different options that companies did, if I were to summarize it. One is to follow 280E to the letter of the law, meaning that they only deduct cost of goods sold. The other one was to do this allocation according to what's known as 471C, which is like an allocation of, let's say, your rent, your payroll, your utilities, etc., based on the amount of costs that were associated with your inventory. So let's say you had a dispensary and it was 2,000 square feet and 25% of that was the back area for your inventory, then, they would deduct 25% of their rent to cost of goods sold, etc. So that was the second strategy. And the third, and there were some other ones too, but I'm just doing the three main ones that I've seen that were effective. The third is, to take a 280E tax opinion and to use a reputable law firm to do so. And then there are required filings that must be done, compatible with that letter that you get from your attorney. And it's called an uncertain tax position, where you disclose to the IRS, well, if I had followed 280E, this is what my tax would be. And I am taking the position that my company does not have to follow 280E based on the tax opinion I gotten from my attorney. And those companies would calculate their taxes similar to other companies. And the hope being that if it does get audited or flagged by the IRS, that the IRS would say, okay, well, this company had a reasonable basis to take this position, and hopefully penalties would be abated given those circumstances. So those were the three main ways that companies dealt with the burden of 280E prior, both medical and recreational dealt with this prior to the rescheduling. We'll probably still see this in the future for recreational cannabis. And one other thing before I interject, and I'm sorry I'm speaking so much to your first question, but I'm trying to get all of this out there because it is at the tip of my tongue, unfortunately. But the other method that I saw that companies did, which was not as effective, is a lot of companies had very, very complicated structures set up, meaning they would set up a management company, an advertising company, a marketing company, and say, well, those are not plant touching, so those deductions are deductible in those companies, and they try to get expenses out of their company. That method, has been challenged by the IRS and is not as effective. So there are ways that companies have done this, but to go back to your question, the rescheduling of medical cannabis to Schedule 3 opens up the doorway for medical cannabis companies to have a lower effective tax rate and really gives recreational cannabis companies more reasoning to be a little bit more aggressive with their tax position.
So just to make sure I'm hearing everything correctly, so if I'm the banker and I'm starting to talk to one of my customers who's a medical only operator, good news, their cash flow should be improving pretty significantly. And the magnitude of that is, of course, going to be dependent on what tax strategy they had previously employed, but still should be some advantages that they can take there. And then their risk, of course, is declining, that they'll have challenges to their position. They could still have some legacy tax challenges to prior decisions they made, because this retroactivity, at least from what we know now, is only back to the first of this year, and unlikely that the IRS would go back any further than this current tax year. So we are, as you're evaluating a business, it's important to know what they're doing going forward, but also still what they did in the past, because there's the liability potentially that still hangs out there until those issues are fully resolved, or the statute of limitations has expired on those decisions. For hybrid operators, we're really kind of in this position right now of waiting to understand how aggressive, I guess the next decision will be, is how aggressive I can be in allocating costs to my medical license and my medical activities versus allocating costs to my retail or recreational activities. Of course, if I'm the CEO of a licensed operator, I would love to say my whole salary goes to my medical. That's all I think about. And that's what I want my salary allocated to. I'm sure the IRS will have a different opinion on that. And so we'll hopefully hear something soon. We don't have a date specific on hearing back from them on that, but we do expect something in the coming months, correct?
Correct. And you nailed it again. So here I'm extending another offer for you to come and work for CBIZ and do some cannabis taxation, because you nailed it.
Okay. So one of the things that came up in that order is this DEA registration. And I know there's a lot of opinions about the importance or the timeliness of getting that DEA registration. My understanding, I'm curious to get yours, is the tax relief that's provided for medical activities is not dependent on that DEA registration, at least as of yet. That order itself deems medical activities as no longer being Schedule 1 or Schedule 2, and now in Schedule 3, and provides some benefit there. And so we would, what are you advising your clients in terms of that DEA registration?
So we have seen some rulings associated with that in certain states about whether they would accept companies if they hadn't fulfilled their DEA registration. The due date for that is June 29th. I would recommend that every firm look at the rules associated with that and try to get registered. For those that are hybrid, medical and recreational, there might be a little bit more of a wrinkle in that, or they may have to separate out their licenses. We're not sure how that's going to go. On our last call, it was suggested by one of the attorneys that we work with that if it was a hybrid company, meaning that they work in recreational and medical, that perhaps they wait, as we get closer to the deadline to see if there's more guidance associated with the DEA registration. I do not believe that the application of 280E is going to be contingent upon a DEA registration, but all those guidelines from the IRS are yet to come out. So let's sit tight and wait for that. However, if you are a bank and you're, loaning to a company that is a medical, operator, then you might want to add to your stipulations of the inquiry of whether they have started the DEA application registration and gotten it as of yet, or what their plan is associated with that. So this is something that should be added to their due diligence process.
Yeah, my understanding, you mentioned that June 29th deadline for the initial registration. I think DEA has 6 months to look at these stacks of online applications and actually issue the authorization or acceptance of that registration. One of the things that I think that some folks are contemplating or trying to understand better is, if I have both adult use and recreational, am I somehow in violation of my DEA registration if product I manufacture then ends up back in a Schedule 1 channel, which is what the adult use market is. So We do have another hearing coming up later this or June, in June, that will maybe provide some more guidance. I know the DEA is meeting to talk about that. Any hopes that we'll get some relief on the adult use side, or you think we're kind of stuck in this bifurcated Schedule 1, Schedule 3 situation?
Look, we've been hoping for many years on both the medical side and the recreational side. I think it's excellent news. We're building up momentum. There's a lot of recognition, of the need for a change for the cannabis industry on both the medical side and the recreational side. I think we've mentioned some things that are becoming more of relevant from the appearance or the acceptance that, for federal purposes, this is going to be, start to be recognized as a substance that is okay. We saw the ATF applications change recently that basically say you can register for a firearm if you use medical cannabis. We've seen the developments within the bankruptcy space also. Allowing for bankruptcy, in the cannabis market. And we're just seeing a lot more talk on this. So I'm very hopeful, but it's all speculation until we see actually that something happens here. It certainly is leading to the momentum that, ultimately I do believe, but that's just my opinion, that this will, eventually be a rescheduled item for both medical and for recreational, or descheduled. But then, as people are saying, be hopeful, be careful what you wish for, because then you have the FDA and you have other regulatory parties that may impart further regulations upon the industry, and we have no idea what those are. But we're sitting tight through this process, and it's an exciting time.
Absolutely. I know there was a news story, I believe, last week about a large MSO that had their previous tax filings challenged and actually lost out on their position. Anything you can share on that in terms of where they ended up, and are other operators at a similar risk, or was that a unique situation?
I think there was a unique situation. I think that the IRS has been steadfast to remind everyone that they issued a notice about a year ago, basically saying that they're not recognizing these tax opinions, and that it is still a Schedule 1 substance. I'm sure we'll see in the regulations that discuss the rescheduling of medical what the rules are. And I just think that, if you're going to take a position that's contrary to, the direct, change of just medical, then you make sure that you have a tax opinion, make sure that you have all the necessary disclosures, and that you have the appetite for the risk associated with that, and you understand what that is, and you're using the appropriate professionals to do so. You have a law firm, you have a good CPA firm, and you're doing everything that you need to do to make sure that those those bars are in place to protect you if something go haywire. That's all I can offer as far as that advice. We're not really sure what's going to happen.
Before we wrap up here, I'm kind of keeping an eye not only on the IRS stuff that you mentioned, these upcoming DEA hearings, but I'm also curious to see if the SBA and the USDA offer any guidance on their loan guarantee programs. Bankers often rely on those for industries that are or newer, or maybe represent a little bit higher risk to the financial institution to help offset some of that risk. So that could be positive for the industry too, if we get some additional guidance there, which we had previously seen on hemp, for example. I'm curious, what else are you keeping an eye on that we should all also be keeping an eye on?
I think from the perspective of banks, and I'm hearing this a lot from operators now, that those that are participate in the medical industry and those even in the recreational industry, they're going to start to be a lot more institutional lenders, and availability in the banking industry, hopefully, and more guidance from potential lenders and equity investors that they want to get into the space. The outlook looks pretty favorable, especially for medical, and their profitability, their cash flow, their ability to just operate in this market without as many burdens it's wonderful. So I think from the perspective of a banker, you need to be cognizant of the fact that your clients are going to start to perhaps require or demand more services, more lending, better terms, less fees, because the space is going to get more competitive. And this might be the time that more banks get into the space if they haven't done it, because it's there should be less issue with it, especially from the medical point of view, because now this is federally legal, and that was the reason that a lot of these banks were not in it to begin with, and now they don't have that reason anymore. So this is really the time to charge into this industry and start to learn about it if you're not already in it.
Well, I appreciate your optimism, and Jill Scher of CBIZ, always enjoy talking with you about these issues, and I hope as things evolve over the course of this year, we can pick up the phone and call you again and get an update on how to be thinking about all of these issues. Have a great rest of the week, and thanks for your time today.
Thanks so much, Tony. Have a great day. Thank you for having me.